All right, welcome back to part 3 of the 2025 annual Roundtable Prime here at DoubleLine. Today, what we're going to finish up the segments with is lessons learned in 2024. Hopefully, everybody learned something this year. And secondly, what the best idea is for 2025. So let's start with lessons learned. Rosie, why don't you kick us off? What'd you learn in 2024?
Yeah, sure. I'll be the pinata.
You can punt. This could be like a white elephant party. You can give it to somebody else.
Lesson learned is that I have to have extreme patience for my calls to come to fruition. And there's some things got in the way, especially on my economic call, which was not right. It was wrong. But I made two critical errors because, of course, in our business of forecasting, your assumptions drive your conclusions. So if your assumptions are wrong, your conclusions are going to be wrong. So what I learned is that my assumptions were wrong, and hence my conclusions were wrong. I didn't think, for example, that the $2 trillion stimulus checks that were issued back in the winter of 2021, I didn't anticipate that all of that was going to get spent. I underestimated the degree of narcissism in today's society because I relied, I guess somebody had mentioned, maybe it was Jim, maybe it was Jeff, about how, the models have changed. Historically, when confronted with a stimulus check, the household sector traditionally would save half and spend half, but they spent all of it. And I didn't anticipate that, and it couldn't be spent all at once. You can only buy. You're not going to buy patio furniture twice in the same week. But the money kept on getting spent. The economy reopened. People went Carnival Cruise, and people went and spent on fun and experience. And I was a little blown away because one of the things that really underpinned, because look, a lot of this is psychology in the realm of economics. That we went into COVID with half of the U.S. household sector having not saved enough money to get through 3 months of vital economic activity, which we did with the lockdowns. Hence, we needed to get the stimulus checks. And I think that people have built up this view that Uncle Sam will always be there for me. So they spent all the money. And that was an Energizer Bunny gift that kept on giving that undermined my recession call. Now, on top of that, what I didn't anticipate was this. I did not anticipate in 2024 and up until now that we would have the massive fiscal stimulus that's ongoing. I did not predict that we're going to have another year of over 6% deficit GDP ratio. I did not anticipate that. We're 2 months into this fiscal year, and the deficit is up 64% year over year. Now, this is before, I'll say his name, Trump. This is before Trump takes office. We're up 64% on the deficit, and if left unchecked, the deficit will be $4 trillion this year. It'll double. 64%. Now, the components are this. Government spending is up 20% year over year. So, I don't know, we talk about American exceptionalism, and I'm a Canadian. And I get it, but America has always been exceptional. That's nothing new. But you see strategists and analysts and economists, they like to take the narrative and fit it in to the price action. So it's American exceptionalism. Well, in this particular case, there's no other country in the world that's running 6% deficit GDP ratios. The average in the rest of the OECD is 3%. In America, it's 6%. And you're going to get some multiplier impact on the economy.
Isn't that because we're exceptional and borrowing money?
Half the growth, that's right, exceptional. Half the growth in the economy. Actually, if you strip bare naked and you adjust it for the fiscal stimulus, direct and indirect, it's 1.5% GDP growth. It's not 3%, and it's not negative. That much is true. And maybe all the AI spending and the R&D, maybe that's obviously helping out. But I'd be closer to my recession call at 1.5% because it is stall speed and it is intensely disinflationary because potential is much higher than that. But I got the fiscal side way wrong. And then what's on top of that is, do you know that government revenues are down 7% year over year? Did you know that? Down 7%. Why? Because of all the subsidies, the EV subsidies, the chip subsidies. So we have fiscal stimulus on steroids. The only time we've run 6% deficit GDP ratios was to fight a recession. We have a deficit. We have a budgetary policy aimed at fighting a recession, but there's no recession. A budgetary policy aimed to fight a recession that doesn't exist.
It's to prevent a recession.
Well, maybe it's to prevent a recession. However, that's what I got wrong. My assumptions on the economy were wrong. Okay, my assumptions on the Fed not continuously pivoting every 3 months, because I was a hero. I was a hero in September when the 10-year note got to 365 for a millisecond. And all of a sudden, 100 basis points later, a goat. Now, I think that, and this is where I'll differ from Ed Yardeni, there is no such thing as a bond vigilante. That does not exist. The most important determinant of rates out the curve is expectations of Fed policy. And what the Fed did, and this is where words matter more than deeds, the Fed cuts rates, and then they, in September, started to sound hawkish. Now remember, at those yield lows in September, the futures market were priced for 9 rate cuts this year. And at that September meeting, the most important thing was they stayed at 4 in the dot plots. They went, no, 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 no. In this game of chicken with the markets, we're not following suit. That was the story. And now they're down to 2 cuts for next year, for this year. The market's basically now overrun the Fed, barely more than 1 cut. But this is the game of chicken, okay? Like this talk about bond vigilantes, with all due respect, from the October peak in the 10-year note yield of 5%, we got down to 380 in December of 2023. Went down 120 basis points in short order, and the deficit cumulatively was up $500 billion. Where's the bond vigilantes? Doesn't exist. It was about the Fed. And then when we went from the 4.8%, 4.7% peak in April of last year, went down 100 basis points into September, it was $1 trillion of accumulated Treasury borrowing. Where were the bond vigilantes? They don't exist. It's just pure bullshit. It's about the Fed. It's about the Fed. And now it's Charlie Brown, Lucy, and the football. And so I'm going to say, and then I'll shut up, that I am bullish on the bond market. I'm bullish on Treasuries. I think that I think the economy is going to be weak. I don't know if it's going to go into recession or not, but I do think, and this comes down to why I was going back and forth with Jim, I think that demand growth will slow much faster than the prevailing supply growth in the economy. Inflation is going to come way down and surprise everybody. And I think the Fed is going to be cutting interest rates more than what's priced in right now. We probably will go back to where we were priced in September. It wasn't that long ago. And lo and behold, next thing you know, we're going to be sitting here 6 months from now, and we're back below 4% on the 10-year note. That's a 10% total return, and that's my call for the year.
All right, I like it. I will summarize that. The presupposition, if false, leads to incorrect conclusions, and thus buy Treasuries. Charles, lesson learned, and that's give us the idea too, since Rosie kicked it off that way.
You know, it wasn't really lesson learned, but lessons I'm trying to remind myself. I got out of a lot of things early. App loving. You know, we were up, 70% sold it, left another 250% on the table. You know, we got out of Palantir at 50, it's at 70, you know. But I know I've been at this a long time, even though I know I look young, that we know what happens, right? We know what happens. And I'll give you a prime example of this. So November 20th on my show, I do a segment on quantum computing. No one in financial media had done it, and I put up 3 names. 2 of those names went up 1,000% in 4 weeks. The other one was a laggard, went up 500%. And so people in the building bought the stock, all kind of whatever, you know, people were telling me, hey, I bought that INQ. And so I came on the show and said, listen, I told people to take profits. And I did this a few times to let everyone know. So, you know, CES comes, Jensen Huang says quantum is about 30 years away and it gets smashed. Phone's ringing off the hook. And it's a reminder, right? I mean, and it's to the point, like, how do you make sure you get out of these things in a certain way? So, again, it's a delicate thing because you do every day that you see that, man, I could have made this much more and this much more. Now, we do this for a living. We have to, first and foremost, our job is to manage risk. Then after that, to try to make people money. But most folks out there, particularly now, and Jim, you brought this point up, want grand slams. And it's not just the retail investor. I mean, money managers are having a tough time. You've got to have a couple of grand slams. You've got to be able to have 50% is good, but you know, people out there saying I had a 10 bagger, right? So it's reminding myself of lessons in an environment like this, not to lose sight. As we go into a more volatile market where, you know, there's going to be some trap doors. As far as individual stocks, I'm going to give you a name that's a non-Mag 7 name. I think Starbucks is one that everyone should take a close look at. And one of my there you go. And one of my things is, and when I make big long-term investments, is I invest in people. A couple of years ago, when GE, everyone wrote off GE and they hired Culp. I looked up Culp's resume, and I wanted to kick myself in the ass. He's the same age as me, and this guy's his resume is just phenomenal. I put a shit ton of money in there. I had no idea they were going to split it into 3 companies. I had no idea what they were going to do. I bet a shitload of money in this guy, and I've made so much. I don't even know when I'm up. I don't even look anymore. That's when we have a luxury, you know, to care. You know, oh, it's down $2 today. By the way, it's 3 companies, right? 3 different stocks, and a couple of them are hot. They're in the energy space. You've got to be in the energy space. This nuclear power thing is real. Yeah. You have to have some exposure there. Now, if you want it on a broad base, a Constellation Energy is fine, particularly after they took a little bit of pullback on a major acquisition. If you want it on a smaller space, SMR is a name to take a look at. Because depending on how the regulators are, a lot of these large firms are, you know, they're going to just say, hey, we'll make our own small mini nuclear power plant, you know. Some of them actually think they can actually take nuclear subs and take their power, but they, you know, I don't think the military would allow them to do it. But they're going to create their own. If they can't get 3 Mile Island reopened, if the regulators are still, because one of these plants are shut down over the mating habits of the salamander or something, you know, one of these weird things like, are you kidding me? You know, I just talked about how our destiny is tied into us dominating this field. So, you know, the lesson is I think for me, the lesson is remember the lessons that not necessarily you learned today, but that you've learned in the past, and don't let them get away from you in these heady environments, because this is a very heady environment. Obviously, you're right, Rosie, it will come to an end. My whole point is that I don't know, so I'm not going to jump out until I have more clarity, but I hope I have the wisdom to jump out, and I think I will, because I left a lot of money on the table last year by sticking to my rules. You have to have rules, and you have to stick with them.
Yeah. I think that's great advice. I will tell you, I had a grand slam last month. I was going down into Orange County, and I stopped at Denny's and got the breakfast. It was great. It was only like $10. I was like, wow, that's inflation. Anyway, here I am complaining about price levels. Danielle, your turn.
Humility. Right now, we just had revolving credit contract by $13.7 billion in November. We saw contracting revolving credit in June of 2008. So we were halfway, 7 months into the Great Recession. Median unemployment is at 10.5 weeks. We saw that in September of 2008. So we were closer to the end of the recession than the beginning of the recession. So many signposts right now with the revisions suggest that we're going to be backdating this recession into 2024, which is exactly what the National Bureau of Economic Research does, or at least it's what they've done historically. But it looks like payroll losses started sometime in the spring, summer of 2024. And once the ink dries on that, that's fine. But here's where the humility comes in. It doesn't matter if I'm correct on my fundamental macroeconomic call if the momentum and the narrative are against it. So it doesn't make a bit of difference. So you have to respect positioning, you have to respect technicals, and you have to respect a narrative when it's as deeply entrenched as it is with the biggest players in the market.
It's amazing because people always say, well, the stock market's not the economy. But,
yeah.
But when the stock market goes up, people think the economy is doing very
well.
Right.
That's right.
Yeah. So, idea.
So I do think that we are in recession right now. And I think that that's bearing out in a lot of the data. I think the consumer is going to continue to get whacked. You've got 5 million Americans who haven't made a payment on their student loan since March of 2020. The Biden administration cutely bought 2 days. So you're not going to see any of those delinquencies get reported until May of this year. But the chickens are finally going to come home to roost. My point is, if we've got a K-shaped economy, a big chunk of that K is going to start to get chipped away because you're going to have higher net worth individuals who did not qualify for student loan forgiveness get their credit whacked at a time when, if you're a middle manager and you've got a decent resume, good luck finding a job because it's really difficult to do. So I think the consumer sector is going to get hurt this year. My highest conviction calls that the Fed's going to be forced to lower rates probably 4 or 5 times this year. But in terms of sectors, I think you should be very wary of consumer packaged goods, consumer staples. They've had one heck of an easy time for the past few years raising prices. They're running into a pricing power wall right now. So I'd be short consumer staples, consumer packaged. I think anything with exposure to China, and by definition, countries that are reliant on China, Europe, Brazil, short materials. And as I said in the last session, I think that the 2-year honeymoon that we've had since Silicon Valley Bank is going to end. I think the era of extend and pretend is coming to an end in 2025. I think bank regulators are going to be called upon to say, you can only default on a loan so many times. So I think that I would be looking to short the banks here as well. Maybe not the biggest, but definitely short the banks here, especially some of these regionals.
Yeah. Okay. Jim?
Momentum. And I want to talk about momentum in a couple of ways that's been mentioned before. A lot of people in the investment business, we go to fancy schools, we get fancy degrees, we have sophisticated theories, but at the end of the day, we're all momentum investors. If it's going up, we get all excited and it's going to keep going up. And when it's going down, all hope is all lost and it's going to be all over. And let me throw in one other parallel to that. We are ruled by DraftKings and FanDuel. We are a gambling culture that would make the Chinese blush at this point, the way that we continue to gamble and how
it's sad in sports now. You can't
Yeah,
watch
it's
a sporting
ruining-
event
it-
without
it's-
giving you live updates on live.
it's ruining sports and all that other stuff. But that's a whole nother section that we need to have after this. And because of that, I think what I've learned again in 24 is because we're so driven by momentum in gambling, every trend is going to go way further than I ever think it's going to go. Both directions is where it's going to wind up being. And that we seem to be whether boom bust. And it might even transcend just financial markets and kind of the way that we think about a lot of things that we overdo it. Look at the election, right? It's always the greatest election of our life and human history is on the ballot and all of this other stuff. And it rarely ever is at the end of the day. I managed to say that without using the T word. And so I think that, as far as momentum goes, that's going to be the thing that I want to focus on is that if the markets are going to be boom and bust and I want to be sane, I think what I want to do is I want to try and focus on where I should be investing longer term. And I kind of hinted at this before. If you look at valuation, Rosie says it's not a timing tool. Absolutely, it was never meant to be a timing tool. It's a good expectations tool. Look at valuations and says, what should I expect this investment to do over the next several years? And I hinted at this before. I think in the bond market, you could be probably looking at a 5-ish% nominal return in the bond market. In the stock market, maybe a 6% or 7% nominal return. The stock market is going to give you more risk. It's going to be a bigger thrill ride. The bond market will have a little bit more less volatility. But what's changed now that we haven't seen in the last 20 years, if what I'm right, I just described a bond market that can compete. Before, the old 60-40 portfolio, which was 60% stocks, the 40% bonds was crash insurance. You were supposed to buy these things in case the stock market blew up, and then the bond market would rally and offset your gains. Well, that didn't work in 22. But I think what we're talking about is I want to churn out investments more than the idea of inflation. And if I could beat inflation by 2, 3, or 4%, I'll be happy with that. And yes, there will be years like 24 where Bitcoin's up 120% and gold and the S&P's up 25%. And everybody's asking me, what is the next grand slam? Because it's all I care about. Because there's always a grand slam. And if at that point, that will continue until it doesn't, and then everything will go down and all hope is lost. And if I want to churn out throughout all of that while the world is doing this, I think I'd be very happy at the end of the day. Now, how do I want to invest? I'll give you one last thought about investing. DoubleLine did not pay me to say this, what I'm about to say. In investing, passive versus active, the data shows that it is very difficult for an active manager to beat a benchmark in the equity market. Why? Because of some of the things we just talked about. You have to be fully invested in all of the all-stars. You have to be fully invested in NVIDIA, in the Mag 7. And if you're not, and usually you're not because the CFA taught you that these are overvalued and risky companies and you shouldn't have 35 or 40% of your money in it, you underperform. But the active-passive data in fixed income is very different. The index usually comes in around the 50th percentile, not the 95th percentile like it does in equities. And active management in fixed income is a better way to go. And it solves the question that a lot of investors ask me. Okay, if you tell them buy AI, buy generative technologies, buy energy, buy broad-based measure stocks, they all nod their head. They nod their head. What should I do in fixed income? And if you start talking to them about, well, if you thought about structure, if you thought about, corporate bonds, or if you thought about asset-backed, their eyes glaze over. You have no idea what they're talking about. Give it to a competent active manager is what you should do in fixed, and look for passive kind of themes or passive investing ideas in equities.
All right, and we did not pay him. Our compliance officer would not allow that. So that was unscripted. That was all attributed to Jim Bianco.
Right.
So I think our CCO is here, so hopefully he's heard me. Okay, with that, Jeffrey, why don't you wrap us up?
All right.
What'd you learn in 24?
Well, I'll get to that. The first thing is on the momentum. One thing I've learned, not just in 24, but over the course of over 4 decades, is you might be absolutely right on kind of a roadmap for the future, but it's going to take a lot longer than you think. Everything lasts longer than you think is possible. And so I think what I learned, though, in 2024 is that I was giving Jay Powell too much credit, that he had really kind of sobered up and was getting more thoughtful. And yet he's really back to what I said when they started tightening interest rates on national TV. I said, the guy is really at heart Mr. Magoo. And, he can't see very well. He's got that jalopy, and he crashes into dumpsters and stuff. And that's what he's doing. He looks so solid back in September. And then it slipped on to December. And what he's really doing, and this is what I taught 2024, not what 2024 taught me, the Fed follows the 2-year. If you want one thing you can take to the bank, the Fed does not lead the 2-year. The 2-year leads the Fed. When the Fed was so out of step back in the summer, July and September, they were miles away, the biggest amount they were ever away from the 2-year. And all of a sudden, he came up with the word recalibrate, saying that nothing had really changed, but we're recalibrating. Why? Because it was a massive gap between the Fed funds and the 2-year. And so he cut 50, saying
July, right?
saying maybe we should have cut in July. So he cut 50, then he cut 25 again, then he cut 25 again, and he's right on top of the 2-year right now. He's right on top of it. So I think what I like for investing is not as quite on the Warren Buffett 30%, but I like 25% cash for coming opportunities, and you're not getting killed that badly while you're waiting for that to happen. It doesn't have to be T-bills. It can be shorter duration, high quality fixed income. And then I like about 50% in fixed income, intermediate part of the curve, although I would put 10% of it in long treasuries, in spite of everything that I've said. But they have to be the lowest coupon possible, because the only way that you have crash protection on treasuries is if they don't get restructured. Because if they get restructured, you're totally hosed because your crash protection goes away. What do I mean by that? Well, the interest expense is out of control. It's already gone on longer than it should. It's going to keep on going longer because that's the way the world works. And if you think that it's impossible that the debt could be dealt with by restructuring, you're not looking at your history. Do you remember when the GM pension plan, when GM went bankrupt, was facing bankruptcy, they rearranged the priority of the investors. The senior secured bondholders were subordinated to the pension system. And the senior secured bondholders were essentially restructured in terms of their order in the queue, and the bonds got killed. That's not supposed to, that's illegal, but they did it. Then came 2007, 2008. The prospectuses of these $2 trillion of mortgage-backed securities said in plain English, these underlying collateral mortgages cannot be refinanced restructured under any circumstances. Then we had these en masse defaults and people mailing in their keys, and they said, somebody's got to do something. So they said, who cares what the prospectus says? It's illegal, but we're going to restructure these mortgages. We're going to modify them. And the people that own AAA rated, very high quality pools of mortgages lost 45 cents on the dollar pretty quickly, right? Then we had COVID, and they said, oh my God, we're locking down the economy. We're going into a depression. Somebody's got to do something. I know the Fed will buy, or at least talk about buying and maybe start buying corporate bonds. That's illegal. It's prescribed by the Federal Reserve Act of 1913. Am I right on that, Danielle?
Absolutely right.
You're the expert on that. So who's to say that when the interest expense becomes completely unbearable, perhaps by long rates going up, at least temporarily, they say, you know what? We got a lot of sixes out there. You know, the average coupon on the Treasury debt might be at that point 3.5%, 3.75%, 4%. I know how we can save. Let's just say it's at 4%. I know how we can save a lot of money on interest expense. We make a decree that the coupon on Treasuries that is either 1% or the actual coupon that was printed on issuance. There will be bonds. The sixes will turn into ones. The fours will turn into ones. The government will save 75% interest expense, kicking the can another several years down the road, and the bonds that are sixes will drop about 70% in price. The bonds that are ones will not lose any value. So you will have your cash protection, but you will not be subject to the unreliable actions, debt management of the Treasury Department in cahoots with the Federal Reserve. So I like 10% long treasuries, but they have to be a certain type. Then I like not junky triple C, low single B. I like middle part of the credit curve, particularly in the two cheap sectors of the market, which are mortgage agency and commercial mortgage-backed securities, which are now ranking in the bottom third of valuation, whereas corporate bonds, junk bonds, equities are ranking in the top decile or 5 percentile. And the 25% that's left, I like 15% in an equal weighted S&P 500 fund. I don't want the market cap weighted. It'll probably continue to make money, as Charles says. It goes, and I say it goes farther than you think too. And then I like two other two other ideas. I like your nuclear power inclination a lot, because if you think these data centers and all this AI has any future at all, you got to pump out a whole ton of energy that we cannot do. And the only answer to that is nuclear, I believe, and it can be safely done. And also on that note, but it's not terribly related, investments in uranium production, I think, are interesting for me, 5% of the portfolio. And if I have 5% left, I'm going to use my perpetual investment, which is INDA, the India equity market, which I would hold for the next 30 years at a minimum. So that's where I am.
All right. To Jim, you should have been a young analyst on the desk with us, because one thing I always like to do with the stock market is, and you guys should all do this experiment, and you go to Ken French's website, and he has all the factors and downloaded, right? Or you get all the factors. You can get momentum, you get value, you get the market, and you get the small cap. And if you download those, it decomposes the return of the market into those four components. So you can plot it individually, and that's what ultimately gets you the return stream. And if you plot the growth of a dollar, I forget how long the data set goes back, but I want to say it's to the late 20s.
Yeah, 26.
Yeah, 26. Okay. I knew you would know that. And so if you plot those four series and you don't label them, and you ask an analyst to come in and rank them, almost every single time, that top line that massively outperforms everything, especially on a compounded basis, the analysts will pick either market or value. And the answer is, obviously, we all know this now, it's momentum. And so I think there are good lessons, and I'm glad that we're discussing this, because I've always said that valuation, Dave is right, it comes home to roost. That's why we get that. Yeah. Secondly, we have technicals, which teach you how to trade, and momentum and money flow are the most dangerous beasts out there. They drive more price action than anything. So it's both directions. So with that, we hope you've enjoyed this year's Roundtable Prime. We appreciate you guys taking a look at everything we're doing here at DoubleLine. I want to thank our guest who bared the fires and everything out here in Los Angeles. So thanks for coming, and we look forward to speaking to you all again in the future. Thank you again.